Okay, very good afternoon to all of you. As per our monthly market update, we are going to show you some data points about what exactly happening globally as far as the equity market and debt market is concerned. So today's topic will be divided into four parts. Firstly, we will discuss something about what happening globally in a global equity market. Secondly, we'll discuss something about Indian economy and various data points which you can get. And third, we'll discuss about Indian equity market, followed by the Indian debt market. And at the last, we will discuss some pointers about what are the investment opportunity currently available to all of you. Okay, so I will be talking precisely on data, and I will let more the data speak for you rather than myself giving my opinion. Obviously, I will give much my inputs in between. So as I go ahead, firstly, we'll talk about a little bit of data about the global economy. Uh, when we talk about the US economy, which is the world's biggest economy, in the last couple of years, we have seen that US Fed has been printing a lot of dollars into the market. From the COVID in the last 1 year, 1.5 years, like from the March 2020, as the data suggests, you see that there's a huge amount of US Fed has print dollars into their economy, and they have actually given money to the US individual investors or US individual customers in their hand to overcome the COVID situation in their country. Now, what exactly happened? The data suggests that you can see this data from 2003 onwards, like the kind of US asset in billion increase to 2020. It has been humongous billion increase, man, from 772 billion asset in US today. They are like 7,720. So that's a huge increment of their asset, nearly 1,000 percentage increase. Now, what exactly has happened because of this huge printing of money into the US market? Now, the data suggests in the second is that the because of that, and why they have printed this money, because they have a huge budget deficit as a percentage of GDP. Because of the COVID in last year, they have pumped in a huge amount of money into the market just to meet all the budget deficit that they have, whether it be the healthcare sector, whether it is pumping the economy out of the crisis situations. So that's what happened in the US. And but despite pumping so much of money into the market, US interest rate has been lower. In the subsequent slide, you will be able to know US interest rate has not increased that much. And that is the reason why they have keep on pumping money into the market. And inflation is one of the biggest parameter where the market, where the economy and the market will heads to. Like we as an investors, we always look out the different data points about different graphs, technical and all those things. And I have mentioned in all my seminars and webinars that the only one parameter that you need to look into is inflation rate. So if your inflation rate is moderate as far as the country's inflation expected level, you don't have to worry about any situations arising. COVID is supposedly a small time phenomena, but if you have seen all those data points where I have marked red point out here, bearing COVID this time, inflation has shooted up, and as a result, US economy has plummeted. Okay, so but this time, surprisingly, despite pumping so much of money, US inflation has not gone high. Why? Reason is most of the money that US have pumped into the economy, they have gone towards buying equity shares. Okay, US as a company, US as a country, a lot of retail investors have buy a lot of equity investment in the last 1.5 years, and that as a result, you have seen there has been a rally across the market in be it in India, China, and anywhere in the world. In last 1 year, I've seen humongous growth in the equity market with obviously with the US economy also. As you can see that Japan has been buying hugely on the equity. Japan interest rate is negative. You all know about that thing. And the Japan Bank of Japan is busy buying equity humongously from the last couple of 10 years. And precisely in the last, what happened in the last couple of years, even today also, we have seen the major rally in the equity market globally has been in the technology sector. Now, as I mentioned earlier, global equity funds are receiving record flows of equity, and that has been mainly driven by the US economy. I have shown you the data that they are pumping so much, they have print so much of US Fed money that most of the US investors, rather than buying the daily necessities, they have gone and ahead and buy stocks, and that is the reason world across, you have seen a huge rally over the period of time. Now, why the question is why the people bought equities? Okay, this data, this precisely data will give you a picture. Standard and Poor 500, which is the US stock market index, now their dividend yield, uh, if you see the dividend yield of the stock market with that of the 10-year treasury bond yield, it's much higher. See the 10-year treasury yield. Now in India, if you see the 10-year GSEC yield, the 10-year government securities yield is near about 6%, like 5.93, 6.34. It's hovering around that level. Whereas in economy, you can see 1.52%. Now, when I say 1.52% as a US economic treasury yield, this is the safest interest that the US investor can get by investing in government treasury. In India, if you're looking for a safest instrument, your return will be a 10-year government GSEC bond, which is at the range of 5.95 to 6.3, near about. So, if an investor is getting 1.5% assured secured return vis-a-vis Standard & Poor dividend yield, if you see the US, which is around humongous, it's 58.5%. So where will a normal investor will invest? Okay, so that's the point. And when I talk about this 1.5% US Treasury yield, and if you see the US inflation, which is near about 1.5, 1 to 2% level, so it's near about bottoms out. So if you are putting money in a fixed instrument where you are getting 1.5% and your interest rate, sorry, as inflation is also 1.5 to 2%, barely you're not making any money. And the 1 year's time, your money value is equivalent to the what inflation has rise. Vis-a-vis, if your people are investing in equity, you will see the kind of return that they're getting. In many countries, this is negative also. Like in US, if you see the treasury yield is 1.52%. In Germany, in European countries, some countries, this is negative government yields also, bond yield. So a person who are investing in equity market, there is a probability of getting gain and loss. Whereas in a debt market, government treasury yield, you're getting a negative return, and if you add inflation to it, it is further negative return. So one way, if you're investing in debt market, there's a short negativity, whereas in an equity market there's a 50-50 chance of positive and negative. So where an investor will invest, they will obviously go towards the equity market. And over the years, we have seen that equity market has performed tremendously, and that is one of the main reason why global investors have invested equity so much. The data also suggests, if you see the data out here, there is a huge global equity funds are receiving record flow, and this is data is from 2008 onwards to 2021, and we have phenomenal global inflow in equity market. Now, moving ahead, we talk about the Indian economy. So in global economy in nutshell, we can say that US has printed a lot of dollar, and they have given to their customers, to their citizens, to come up from the COVID crisis. And most of the dollar they have given up, they gone towards the equity market globally. And when there is a huge FII flow across globally in different market, it impacted all market across. The good point here is, despite so much of inflow or so much of US Fed printing money, the inflation has not gone over the top in US. And Fed categorically, they had already said that till 2023 they are not going to increase the interest rate there. So that precisely means they're expecting inflation to be in a range bound from 0 to 2% in US. So if the inflation is range bound from 0 to 2% in US, so we don't see an interest rate hike, and they will continue to support the equity market as such. So if they increase the interest rate out there, obviously the equity market is going to take hit, because once the interest rate goes up, the balance sheet affects, the expenses incurred a lot for the companies. So which if the US Fed is predicting that much, we expect it is going to reflect in Indian economy also. I'm going to show you the data point, you will be able to understand from that. Now, when we talk about the Indian economy, let's talk about what exactly happened in March. We have seen in the last 1 year, COVID phase 1 has happened, and just right now we are having hammered by the COVID phase 2. But in the March, despite all those things happening, we have a phenomenal record month of March. Now, GST collection in the month of March is highest ever, 1.2 trillion. And if you see the data of whether it export, import, rail, and every data point, we have seen a huge growth over a vis-a-vis in the last 1 year time frame, and some data point are in fact the record high. Going with individual data point, if you see the real GDP growth expectation with the inflation curve, now this is above is a CPI inflation, which is a this is a core inflation which we normally have, and this is a WPI inflation. So if you see from the November 2019 to February 2012, 2021, our normal CPI inflation and WPI inflation is normally range bound. Now, if you were aware that in India, the RBI governor has basically fixed our interest rate inflation target from 2 to 6%. So, and precisely bearing a few point in 2020, our inflation rate is moderately low. So, if our inflation rate is moderately low, we don't expect to interest rate to go high from here. Till the time our inflation is near about 5% right now. If you see the data point, 4.2, it is slightly increased in March and April. So it is near about 5% right now. So if the inflation is at range bound from till below 6%, we don't have a reason to worry about the interest rate going high. Now, if we do not have a reason for interest rate to go high, the equity market will not impacted by that. So that's a main important point. Now, if you see the economic survey, IMF report, and various world governing research report, if you see the data point out here, vis-a-vis FY 2021 to FY 22, every country has said that there will be a huge GDP, real GDP growth in India. So that's the kind of thing that, like say for example, like if you see the economic survey, they're expecting 11%, 11.5%. So normally, precisely, we are expecting, bearing World Bank, we are expecting that 7 to 8% will be the real GDP growth rate in this financial year till 2022. So that's the kind of expectation the world different research firm has. Now, what exactly happened in India, right? So, if you see the data in a macro level, high inflation to low inflation, as I showed you earlier. If you see the data point in 2008, 2010, and 2012, we used to have an inflation rate of 12 to 10 to 12%, and that's why we used to have a fixed deposit rate of 8%, 10%, and even 12%. You get a fixed deposit. Today, if you're getting a fixed deposit at 6 to 7% approximately, because our inflation rate is lower range. So we macro level, we have a high inflation to low inflation, which has happened because of inflation targeting. Now, since RBI, or if you might be aware that RBI has a target of keeping inflation rate between 2 to 6% level. So they have a target of keeping inflation rate in that range bound. You don't have to worry about higher interest rate, and as such, you don't have to worry about equity market hammering down much lower level. We have a high fiscal deficit to low fiscal deficit obviously currently having, and forex reserve, we have a multiple forex reserve. I will show the data from going ahead. So structurally, we are a well placed right now. We have a huge amount of forex reserve. Our inflation rate is our range bound, and we have a very low fiscal deficit despite having the COVID hemorrhage going on. What the structural change which has happened, like infrastructure deficit to infrastructure availability, physical to physical, and digital economy. Digital economy has played a huge role. If you see the balance sheet of all companies, most of the companies in the March quarter, you see the most of the company has made profit. Now, why this thing has happened, you might be wondering that despite the COVID, the why situation, they have made a profit because most of the company, they have become leaner and meaner. Okay, when I say the leaner and meaner, that means most of the companies, they have cut short their expenses by way of employee reduction of salaries, of wages. Most of the companies work from home, and that has decreased immensely over their cost. And secondly, most of the companies, since they've gone digital, they have a better capacity utilization and operational efficiency, and as such, the more better collection in that are happening right now. So we have a crony capitalism to transparency, NPA creating bank lending to merit-based bank lending, concentrated growth to inclusive growth, public sector to public sector strategic partnership. So those are the strategic changes which has happened in India over the years, and that's a major data point. I want to say that most of the people who are worried about what will happen to India because of this COVID second wave, see the data point here. Indian forex reserve has now exceed external debt. Okay, so that's a very important point. Like my debts, my reserve has exceeded my external debt, which was in 2014, it was 70%. Now we have like 110% reserves than our external debt. So, which is a huge data point. India will lead recovery in the post-COVID era, as per the Bloomberg's economic data point. If you see the India's point of view, if you see in 2021 and 2022 projection out there, India will mostly outperform most of the countries across the globe. As far the recovery is concerned. Another headlines point, a couple of headlines which you need to aware of: that construction on national highway touches 37 kilometer per day, which is an Ministry of Inform Ministry in April. Second, GST collection is March is highest ever in 1.2 lakh crore. I have already mentioned that. So despite all this thing happening, we have a highest ever GST collection in March. Probably in April, May, you will find a little bit lower because of this COVID wave, and which I presume that by the end of June, it will start normalizing again once we have a rapid vaccinations across age group, and once this COVID second wave touches its high points and coming back. Indian export has jumped 50%. I've already mentioned railway freight loading up by 24% in March. And couple of other data points: Indian business confidence highest in decade. Indian power consumption goes by 24%. Petrol sales up 27%. Indian March gold imports surged 471% to record 160 tons. eBay bill generations indicate broad-based recovery. Okay, so if you see the data point in February and in March, we have average eBay bill registration is highest ever. In last 1.5 years since it was recorded being digitally. We Although there has been a little bit down in core sector output in February, March it's slightly a little bit down in 4 5 point. The data has not yet come yet, so I've not inputted here. In March, the data is like minus 5.2% approximately. But probably in next 2 to 3 months time, you will see the data point moving up here. So in the last time, during the deep COVID phase, when we were minus 37%, and now we have like minus 5% approximately. So it will go again, move up in next 2 to 3 months time, and that's a major industrial production output, and which you need to figure out. Like there's nothing very deep worry point out here. Improving global trade can support Indian export. Indian export I've already mentioned. Indian sorry, real imports, if you can see, US, Euro, area, and Japan. If you see the data point out here, we like US, it has been import has been hugely improved. Okay, so that's a kind of Indian export where which the countries that we have done so far, it has gone back to the previous level from post-COVID era. If you see this data point, it is in January data point right here. February and March, it will going to higher up kind of thing, as I showed mentioned earlier also. So which is we have normally back to those fields that we used to have a pre-COVID era kind of situations as far as export import goes. Capex revival is the key for sustained growth. The data point I've already mentioned out here. If you see the data point out here in household, in private sector, in public and other valuable investment as a percentage of GDP, it has been increasing. It has increased. It will continue to increase over the period of time. Now, having said all these positive things, now you might be thinking that what is the worry point right now for all of us, since we are invested in the market, are going to invest in the market. So let's discuss about that thing and what are the opportunities lies ahead. Now, obviously, the worry point is COVID. COVID cases has crossed the peak of 2020 level. So I don't need to discuss about this thing. The data point is quite evident, and if you see the news report every day, the COVID is a worry point. But you all are aware that this COVID wave, second wave situations will not last as long as the first wave, because we have a biggest thing that we have the vaccination in us, and right now we know what the disease is. Unlike last year, we are not aware of what is the kind of disease that COVID thing. This time we are aware of the disease. This time we know how to make control of it. And third, we have a vaccination in our place. So probably in another 1 or 2 months, you will find things will normalize. And why this time? Last year, if you remember that we have 97 to 1 lakh per day COVID, and this time we have 3.5 lakh per day COVID. And this is approximately common across the globe. If you show the data point, just a minute. Yeah, if you see the COVID thing is data point indication in US also, first wave peak they have 33,000 and second wave peak they have 70,000. So it is 250 14% increase in per day peak. So if you see that across all data point in different countries, it is like 230, 260% increase in a second wave peak. Okay, so India is probably like 300% peak. So that is in quite sync with the other countries. Because India is a huge populations, we are seeing a huge amount of COVID patient across, and the health infrastructure is getting bullied right now. But I'm quite sure that in next 1 or 2 months things will normalize. The data already said that a couple of strategic analysts, couple of research reports already said that the peak will happen normally during May first week, and you will see the data again coming back to the normal level. So yeah, so that's the second wave has hit activities without lockdown. So that's normal data. And unemployment. So nothing to worry about COVID. Only thing, yes, in the next 1 month things will be difficult. But as I said, that we have a fast vaccination drive, better understanding of the virus, better preparedness of the companies, and you will see in the next 1 month, probably because of the COVID situations, you might be seeing that the stock market is little bit. Just a minute. Stock market is behaving little bit shaky these days. From the 51,000, we are right now at 47,500 level at Sensex. I already mentioned to my equity investors that don't but sit in a cash. Don't, if you're looking for a fresh investment, don't invest right now, because the COVID, because of the panic created basically from the domestic investors, you will see a little bit of correction right now, probably a 5% level. But this is a very short-term phenomena. This is not going to last like a last year, where we market has cracked down to 25,000 level, because this time every companies, most of the institutional FIs, are aware that what is going to happen. It takes 1 or 2 months time, and then things will normalize and again come back to the level. And then once we come back, we again push a little bit higher level. Okay, so 47,500. So in Nifty, I'm seeing that 13,000 or 13,500 level, or in Sensex, we can see 45, 46,000 level. I don't see a much bigger push below from here. Probably in a month's time, we'll see things will get corrected out here. So that's not a worry about COVID situations. Second important point is unemployment is down, but income. Now, we have seen that in last couple of 1 or 2 months, the unemployment data has been down. But the problem here is the Indian income, per capita income, has not increased. Now, most of the companies, they've cut back their employee cost and everything, but they're not gone back to the previous data point. So the income has not increased. That's a worry point rather than COVID point of thing. If the income of the Indian population do not increase, they will not spend much. So that is one worry point. That's a bigger worry point, I will say, rather than the COVID. And so that's one point. So in a risk parameters, if I conclude COVID second wave, you don't have to worry too much. Probably 1 or 2 months, probably in June, you will see the COVID situations improving much better than what we are currently seeing. Income to unemployment ratio, that has to be taken care of. I think once the COVID situation stabilizes, you will see a lot of improvement in that sector. Inflation, I already mentioned, we are a very well poised at 5% level, and we don't see the inflation going high from here. And since inflation will not go high from here, that's a Fed expectation. Fed has already mentioned till 2023 they are not having any reason to hike interest rate. That means we don't have to worry about much about inflation and interest rate, and as such, we don't have to worry about equity market hammering down further from here. So when we talk about the Indian equity market, let's talk about the performance across market cap. Like if you see the Nifty 50, Nifty mid cap, and Nifty 100 small cap. Now, if you see the Nifty 50, which is the top companies, the top 50 companies in India, in this is data point is 1 year return is 71%, 5 year, 3 year return is 13%, 5 year return is like 14%, and 10 year is 10%. It's an average annual return. Similarly, with the mid cap and small cap. Okay, so that's the kind of performance which is given by the Nifty over last 10 years. If you see that last 10 years performance, be it large cap companies, mid cap companies, and small cap companies, the return is 10% CAGR irrespective of years to come. Now, if you see the sector performances over the years, uh, we have seen the metals, in last 1 year sector performances, metal is giving highest return, followed by energy, IT services, and other things. And pharma and media has given a negative return in last 1 year. despite what is happening in pharma. Because I mentioned that why pharma has given this thing is that last 5 to 6 years pharma performance was extremely bad. It's only because of COVID last year they started pumping up. So probably we'll see a lot of opportunity in the pharma space. I just want to mention another point. As today's presentations, I'm going the data. I am giving only the data point. I am not mentioning any company stocks or any fund to pick up. For that, you need to talk to me separately. Don't pick up any company, sector, or funds just basis on these presentations. It is an overall generic presentation that I'm given. If you are willing to invest in any of the stock, you need to get back to me personally. We'll discuss about your investment horizon, risk appetite, and then go ahead. Secondly, if we see the Nifty movers in Q4 FY21, now what are the companies which has actually given rise in the last 1 year, like Tata Motors, Grasim, Adani, Hindalco, SBI, Ultratech, Tata Cement, JSW Steel? They have increased 20, like huge percentage, whereas we have seen couple of companies which have down by like SBI Live, Hero Motors, Asian Paints, Maruti Suzuki, Kotak, and Dr. Reddy's. They are down by the percentage which I've already shown below. That's a mover in the FY quarter 2021. Uh, now, this data point is important, right? I don't know it is whether it's getting clear to you or not. This is from FY to 2010 to FY 2021, and if you see the data point precisely, every year the different sector has changed. Like in some year, if the banking sector has performed, so in some year you will find the auto sector has performed. It is not like every sector performed every year. So that is the precisely I always emphasize that you should go for a professional advice while investing, because just because of seeing the past performance, if you invest, probably the next last year a sector has performed, this year the sector has not performed. This is a 10-year data point. If you see, if you for say for example, in 2020, let's see the 2020 data point. 2020 we have uh, see, in Nifty Reality, okay, so this Reality Index, they have given minus 35% return, whereas in FY 2018 they have given plus 37% return. So this green point is that they have given a positive return, and red is a negative return. If you see all the data point, like if you see the Nifty auto sector, the auto sector in last 1 year has given 109% return. In FY 20 there's given minus 43% return. FY 19 there's minus 23%. FY 18 is plus 10%. So if you see a sector in one financial year that's given positive return, and other financial year is giving negative return. So that what exactly happened if you pick up any sector, that exactly what has happened over the years. Okay. So precisely what this data suggests is that, so if you are investing via past performances, you're likely to get hammered down by the expectation that you have in your mind that the sector has performed better. So it is better that you take a professional advice, or you take a or you invest in a fund which has well diversified across different sector, and they have a huge turnaround ratio internally. Now, you might be aware that there are three ways of investing. Okay, I'm not going to discuss more about it because it will take a longer time. One is the growth way of investing, one is the value way of investing, one is the momentum way of investing. Now, each and every year, this growth strategy or value strategy or momentum strategy changes. Now, just to give you an example, what is the difference between growth way of investing and value strategy of investing? Like if you pick up a value investing, to give you an example, in Maggie category, if I say, like like Nestle Maggie is a growth oriented company, whereas Top Ramen is a value oriented company. Why I mention is that Top Ramen, although both the thing in the same category, they are much at lower range market share as well as in comparing to Nestle. The Top Ramen has a much higher growth potential than as a Maggie in the particular segment. So if you pick up a value strategy, you will pick up companies which are not a market leader, but they have a huge potential as far as the particular sector goes. So that's a precisely kind of a small example which I have given. So into 2021, you will see the value strategy will work like a company probably who those who are not market leader, but the company in that particular sector which is a better capacity utilization, better systems, processes in place, and they have a huge amount of growth prospect lying ahead. So if you pick up those companies, you will get a huge amount of return in 2021. Like another data point which I mentioned earlier also, that US has seen a huge inflow. Fed has printed a lot of money, and most of the money where they have gone, they're coming to India. In last 12 months, FI flow, if you see, India has $36.9 billion in induced in India, followed by Brazil and other companies. It has actually gone down. You know, FI has pulled down money, so most of the money has been pulled down from other economy. We have not taken China here, and it has gone back to the India itself. So most of the FI flow currently is coming to India because of the post-COVID situations. And if you see, because of what China has done over the years, we don't need to discuss about what COVID were initiated and all those things. You will see more FI flow is going to come to India in days to come. India will have a higher earning growth as compared to peers. Like if you see, if we have mentioned the different stock exchanges across in the bottom level, and if you see the India's Nifty bearing IBOX and KOSPI, we have a higher earning growth EPS among in the global market in days to come. So if you are looking for a global investment out here, bearing US, India will be a high growth country in across the globe. Nifty earnings are expected to be upgraded. The data point says so. If you see, this is the Nifty EPS from 2009 onwards. So we have shown that how the EPS is movement. In obviously we have a higher EPS right now because of the data that we already have, and it will be moderated in days in coming 1 or 2 years. So most of the stocks you might be getting at a premium rate right now. Most of the stocks you're getting premium. I will show you the data point in next slide itself, and which probably expected to be rationalized in days to come. So market, well, in a short time, as I mentioned earlier, market will move between hope and fear. So you will have a lot of volatility in next 2 to 3 months. Like May, like June, July, you will see a lot of volatility, increase in COVID and infection, will lock down real economic activity, and we have a hope of mass vaccination, normalcy of economic activity, fiscal stimulus, and monetary stimulus. So market will hover between hope and fear in next 1 or 2 to 3 months, like till June, July, and you will see this hovering around of this thing will happen. But ultimately, in a longer term perspective, we are a very well poised. As I show you all the data, FIs will come back to India. Indian the all the macro and the micro level indicator points are very well placed. Only the short term phenomena which we have because of this COVID second wave will be there in next 2 to 3 months time frame. Like valuation wise and neutral weight, I can say that valuation wise we are neutral weight, and momentum wise we're neutral weight. So what does neutral weight doesn't mean selling equity, it means profit booking if any excess and overweight positions. So currently, if I we don't recommend you to sell your equity positions, but yes, if you have made huge profit in any other equity segment, you can make some profit booking right now, and do not exit equity. That's a very important point that I want to mention out here. The reason, because what are the alternate investment opportunity to you right now? If you go to the FD, it is going to give you 5 to 6%, and if you see the post tax return is much lesser. I show the data point. Dividend yield is in US is much higher than what the treasury yield is giving. In fact, in India also, if you see the dividend yield, last year, I don't know how many of you are holding any stocks of good companies. Last year, mostly the good companies, I'm not going to mention any of the company right now, they have given dividend to the tune of 10 to 15%. And you say, I'm talking about dividend only, I'm not talking about the price. Now, if you are getting a dividend yield of 10 to 15% and your FD return is 5 to 6%, why should you go ahead and invest in FD? Okay, so that's the point of time, what point I want to mention. And equity market currently, if you see, every day we have a movement of 0.5 to 1%. Like if you have a movement of 0.25% every day, and vis-a-vis a 5 to 6% return throughout the year, it doesn't make sense for you to go back to this FD route kind of investments. As I show you the data point, like coming 2 to 3 months, yes, the market will remain volatile and it's going to increase from here, because we will have a huge FI flow to come till 2023 if the Fed do not increase interest rate, and we have all the macro parameters well within our comfort zone. Market cap to GDP, this is a very interesting data point. Market cap to GDP in India is 105%. I tell you that in US it is 145%. So we are way average, way below that global standard. And from average, we are a little bit higher. This data actually says that whether you should get into equity or not. But if you see the global standard, which is 145 to 150%, we are much below in that range. Now, P ratio is an important parameters for investment. Okay, so now 1 year forward P is 20.7, and its average is 17.9, and average in 18. Now in P, I want to give you a price to earning ratio. I'm going to give you a very interesting slide, which you will able to understand why I am saying that you need to stick to equity currently. So I just move to my next slide. Just a minute. Yeah. So currently, if you see the P ratio, reported PAT of NSE 500, if you see the P ratio is 41.2, right? Now, most of the people will find that 41.2 P is much higher. If you see the quarterly, reported profit after tax in December, we have 1,22,000 crore. March, we have 53,000 crore. June, we have 33,000 crore. Obviously, it is down because of the COVID situations. Then September, sorry, September, the profit reported PAT has increased to 1.76 crore. And in December, we have 2,09,000 crore profit, which is reported. Now, all this data point included in the last 1 year, we have currently we have P of 14.1. Now, if we take this December data point, December profit 2.09, and average it out to next 4 quarters, which will come out 8.39. Okay, and if you take September profit and average out to the next 4 quarters, it will come 7.07. Okay, annualized PAT. If you take the December quarter result, so it is coming like that. Now, if the profit increases, your P ratio is going to decrease. Like if we have a 2,09,000 crore profit of the Nifty 500 companies composite for the next 4 quarters till 2021 December, our P ratio will automatically comes down to 23.2. And that's the important data point. Why we are seeing P ratio much higher right now? Because we have a less profit declared in last 2 to 3 quarter, and less profit has declared because why? Because of the COVID situations. If we have a same sustainable profit as far as the December goes, we'll have a huge decrease in P ratios. So that's the important data point. And this profitability will remain intact. Obviously, this quarter, this April, May, June, you will find a little bit lower P, lower profitability because of the current COVID situations, but we'll again come back to the normalcy level. Why this has happened, I've already mentioned. The companies have become leaner, they are making better capacity utilization, they're making smarter, and they're making much more cost effective right now. Okay. So if you see the sector valuation right now, which are the sectors where you currently look into? Like in automobiles, I have already mentioned in last 1 year, it has given a phenomenal return. That we are getting a premium of 38%, cement at 54%. Couple of sectors, the stocks. I'm talking about the sector specific, not stock specific. We are getting a couple of premium segment. But there are a couple of sectors which you are still getting at minus, at a couple of huge discount level. So I have said what is the current PE of that particular sector. I have mentioned what is the 10 average PE of the particular sector, and I'm saying whether you're getting premium or discount. Now, this data point is deceptive. This data point is the actual data point which I've mentioned. But as I mentioned earlier, if you take the December profit and you aggregate that December profit to the next 4 quarter, taking an assumption of same, this current P will also go down. So in a nutshell, you don't have to details, to go deep down into this particular data point. Now, if you see my webinar every month, in next 2 to 3 months, you will see all the P will going down considerably, and you will see most of the data point reversing from premium to discount. So nutshell, the segment which I will still be saying that, say for example, pharma, it's 11% premium you are getting, but I still see the pharma is a fantastic sector to enter, because most of the companies right now, after what happened in China, by the COVID initiation and everything, we are manufacturing all the things right now in India. So you will see the pharma is going to go from higher from here. I'm not mentioning stocks to invest in. I'm talking about the sector specific. Usually, utilities another sector which you can look into. Metals, yes, I'm extremely bullish about metals. PSU Bank is another sector which you can look into. I have already given a call of SBI Bank 3 4 months back, and if you see what is the rate of SBI Bank is trading right now. Okay, so PSU is something bank which you can look into. Obviously, private bank, although there are discount premium segment, but you can still look into the private bank sector. I already mentioned this. Higher earning versus our higher earnings and lower valuation. So I taken a couple of stocks here. If you see the P ratio of Sri Cement, which is a 67, P ratio of Bajaj Auto, which is 20, and if you see the annualized Q1, Q2, Q3, and FY22, as I mentioned earlier, also you will see the P ratio will rationalize over the period of time because of things which I've already mentioned about the profitability growth of these companies. So Asian Paints, which you will have a higher P right now here, you will see the P will rationalize in extended time to come. So, on our recommendations, I can say that if you're looking to invest in equity, you should marginally overweight in small and mid cap segment right now. Large cap, already most of the companies you are getting at a premium rate. If you see in the last 1 year data point, so you can go underweight or remain as it is, and you can go neutral weight in equity. So when I say a neutral weight in overall equity, that means if you make profit in some stocks, you can book right now only the profit portion and stay intact in that equity portion. And if you're looking to invest in equity, go for a small and mid cap companies, do a proper research. Research should be a bottoms up, not from the top down, and pick up the stocks and invest out there. Only the small and mid cap companies, okay? And key variables, I've already mentioned economy in short term. I mentioned that it will be volatility in medium term will rise. The COVID economy, there's likely to be sequential improvement as Indian economy unlocks. Corporate earnings, I already show you the data. Most of the corporate earnings have started giving humongous profit over the years. And in last, despite having COVID in December quarter and March quarter, you will see the balance sheet of most companies, they are making huge profit. I tell you the reason why. FII flow, it's only going to increase in India. DII flow in short term will be negative, is evident. Like from the stock in the last 15 20 days, you will see the Sensex moving from 51,000 to 47,000 level because of this COVID panic happening. That's why I'm saying short term it will remain neutral, but in medium term again people will run back to the domestic equity market because there is no alternate investment available right now. Okay, and obviously I don't see interest rate to going down from here. It will remain stagnant in next 1 or 2 years from now on. Supply of papers, well, that will higher design target and repair of leverage balance to create supply in the market. Policy reforms will, you will have a government have a huge support towards what the economy is going to have, and they have been supporting in the last 1 years by way of OMO and various giving subsidies and pumping money into the economy. Now, that's what about Indian economy goes. Now, when we talk about the global economy, I've also mentioned. Now, we always, when we as an investors, we always look towards investing in Indian market. But you know that Indian market accounts for only 3.3% of global GDP. And India is only about 2.5% of global market cap. So India is minuscule in front of overall global GDP. US have 24.5% weightage in global GDP. China has 16%, and India is 3.3%. Now, if you see the market cap, India is 2.5%, US is 41.9%. So if you are investing and if you are not a part of a global investment, I think you are making some mistake, because as I showed the data point, India is very minuscule as far as the global economy and global market cap is concerned. Now, so what are the options available to us as an Indian investor to take participate in global economy? Couple of data points, like Indian markets tends to give better returns. Okay, so we have this mindset that Indian markets tend to give better return. Now if you see the data point of 2009 to 2020, uh, um, every year different countries are given different returns. Now winners keep rotating every year. So in 2009 to in 2020, if you see the whosoever is gaining, I have seen the data point up here. In 2020 we have a China, US, Asia, and then we have India. And then in 2019, we have seen the data point. In 2011, India has performed well. So every year, if you see the every countries has performed well, some or the other. It is not like India has performed every year consistently over the years. Currency volatility essentially harmful to return. Like we always have mentioned that if we invest globally, because of the currency volatility, our return will be down. But the reality is, currency volatility can impact return in short term, but long term it tends to be secular because historically India is a high inflation economy, and over the long term, its currency will only tends to depreciate as compared to other major currencies. So you don't have to think much bigger about the currency volatility. Short term, yes, it will impact, but in longer term, it will not. So if you're looking for a global investment, take a longer time horizon and going to have a huge return. As I mentioned in earlier slides, uh, India, like in couple of years, India will perform better, but in couple of years, other countries also perform better. Uh, Now, why I mention US? Because market capitalization, the global economy, the US is 42%, and they hold 25% of global GDP. So you cannot invest, you cannot take away US as an investment avenue in your portfolio. Like when we talk about the US from 1980 to 2020, US household debt service and financial obligation ratio, which we have very low right now, currently going very low. And US housing market is on a recovery stretch, as the data suggests. And now US real consumer spending is increasing. In last year, it has dipped a little bit, but they are coming back to the normalcy in the right earlier phase. So understanding that there is a huge prospect of investing in global market. And why I talk about the global market, because every day we are using those global product, be it Google, be it Facebook, be it WhatsApp, be it internet, be it Apple phone. So we are using those technologies day in and day out. And since you're using those technology day in and day out, and your money is not invested in those kind of companies, you're missing out on huge investment opportunities. Okay, so I will suggest that if you have 100 rupees in your kitty, you should have 10%, 10 to 15% to start with, exposure to the global market. Global companies, which are big companies, as I mentioned, Alphabet, Amazon, Apple, Microsoft, Facebook, and all these companies are, Uber, uh, Netflix. So we are using all this company day in day out. And my suggestions will be, you should take exposure of 10 to 15% of your portfolio into these US market companies, which are the world leaders. Now, what are the offering that how you can go to those buy those stocks? Like you can buy Nasdaq 100 fund of funds, where your money will invest in Nasdaq companies in the same ratio as Nasdaq 100 offers. You can invest in a blend fund. The blend fund will have a mixture of Indian as well as a US company. So US top companies, Indian top companies, you have one fund where you invest there. You have a global emerging funds, where the funds which will offer you different markets, small and mid cap companies to invest into. And there is another interesting fund which has come up currently, is that global real estate fund. You can take exposure in the real estate market in Asia Pacific through investment in Asia RET Sub Trust Fund. Okay, so you can, so those are the specific kind of product which has come up. So I will suggest that if you are a first time investors, either you go with a Nasdaq 100, or you can go with a fund which are clubbed as global as well as the domestic funds. Now, domestic in a globally, as I mentioned, US has given in last 10 years, they have given 17 to 18% CAGR every year. And talking about the index, now if you talk about the some stocks, they have given phenomenal returns, like more than 3-digit return year on year that given performing. And all the big companies, if you see the market capitalization, top 5 to 6 companies you will find in US in the globe. And I don't have to mention anything about how Google will perform, how Apple will perform, how Netflix will going to perform, or how Facebook and other company will perform, because we use those products every day in and day out, and we know the advantages and technical advantages that those companies are giving. So that's my suggestions, that if you're looking for a global investment, I have mentioned my link in the chat box. You just click on the chat box, register which are the product that you're looking into, and we can discuss one-on-one about those products and your investment capacity, risk appetites, and horizon that you're looking into, and suggest some kind of products to you. Okay, now the question here is, should we invest in gold right now? Well, we have highlighted risk of import duty being reduced to our gold call. The same has played out in budget 2022 as import duty rationalized from 12.5% to 10%. If the import duty is reduced further, to the extent there will be a drop in rupee gold prices instantly. Subsequently to that volatility, we remain bullish on gold on a longer term basis. Gold has corrected in real recent times, providing accumulation opportunity. Well, I always mention again that if you have 100 rupees, and you should always have 5 to 10% of your investment in gold. Precisely, you don't need to buy gold in physical form. You can buy gold in paper form also. There are gold fund, there are gold ETF available. You can get back to me. I will give you details about how to invest in gold fund. Okay, so but gold has to be in your portfolio in 5 to 10%, and should not be in a physical form. Like if you are buying gold in a physical form, you have to put in a bank lockers. You have the always risk of getting stolen, or you have always risk of giving charges to the bank. Whereas in gold ETF and gold fund of fund, you don't need to think about those things. The price actually reflect every day as far as the international gold prices, and it is very transparent. You can liquidate within 2 to 3 days time. Should we invest in Bitcoin? Like another investment opportunities, I remember in 2014-15 when I was talking about Bitcoin, the India Bitcoin price was 40 to 60,000, and right now the Bitcoin price is 35 lakh to 45, 35 lakh to 40 lakhs. So you from 50,000 to 40 lakhs, you see the kind of growth the Bitcoin has over the years. Now the question is, should I invest in Bitcoin right now? Let's see the data point, like why Bitcoin has increased so much. Because there are huge corporate announcement which has happened over the period of time. Like Coca-Cola have said that they will accept Bitcoin. MicroStrategy has said, Square announces they will purchase, PayPal announces they will support, and then a lot of other companies. Tesla, they have already said that they are going to announce some investment in Bitcoin and all. Mastercard announces support. So that is one of the big reasons why Bitcoin has hugely increased. And secondly point is that when we have so much of global pandemic happening, people normally move towards the equity market, government bonds, and move towards the gold as an asset class. Now this time we have seen that instead of going to the gold, most of the investors have gone towards the Bitcoin, and that's why cryptocurrency, which they find it much safer and much safer from the point of view as a concept, not from the regulatory on hacking perspective, because they have gone to Bitcoin level, because they find that it is out of the regulatory roadblock of individual countries, and that's why Bitcoin has price moved exponentially high. As I said, the 50,000 Bitcoin price, if you have taken one Bitcoin in 2014 which cost 50,000, today it's cost 40 lakh rupees. Okay, so that's fair. Now the question is whether I will get entered into Bitcoin or not. The important point here I want to mention here is that the entire Bitcoin structure, the cryptocurrency structure, it has been held by 2.5%. The entire Bitcoin, only top 2.4% is holding 95% of the Bitcoin. So it is highly concentrated in couple of peoples. Okay, and they are controlling the entire cryptocurrency market. So it's highly speculative in nature, and you can see the market can crack down huge by way of them controlling by any way. And so it is not been regulated. It is highly fluctuating, highly volatile in nature. So this data point I've already mentioned here, and to give you further example, Bank of America says that there is no good reason to own Bitcoin other than price speculations. Bitcoin volatility and high risk return. If you see the Bitcoin volatility, I will see the data point. Across the year, there were huge volatility. And if you see the volatility of gold, silver, euro, and Japan, you will see the huge less volatility in other currencies than Bitcoin. So that is the reason, like if you're investing in Bitcoin, like there's a huge volatility the factor that you take into consideration, and it is concentrated since it is with couple of people at the top. So that's the kind of risk that you have. The price can collapse any point of time. Okay. And secondly, and second, in Bitcoin, it is important that in India, the government of India is coming up with a bill where they are going to penalize investors who are having a Bitcoin. And it is not, it has been drafted, it has not been presented in the parliament to pass. So I will say that the Bitcoin investment scenario in India is very in ambiguity stage, and we should wait for a couple of months before taking a call of investing into the Bitcoin. Because of this holistic nature, volatility, government regulations, ambiguity in taxation, and all those things, you should take off from this currency right now. Now, debt market outlook, will not take much time from here. Interest rate, as I've seen that from 1942 to 2020, it has gone high in 1981 was 15.19% and has gone back to right now in 2020 level in treasury note it's 1.5% level. So okay, so we have a huge interest rate cycle from 1942 to 2020, like 80 years. We have gone highest point at 15% and now back to the 1.5% level. And RBI in back to India, they are keeping the overnight rates and repo rates is much way in control. As far as the I already mentioned, interest rate is always a reflection of what inflation rate is happening in the country. CPI, it is comfortable zone. I already mentioned earlier. FI activity, well, we have seen a couple of investment in FI activity in March in India. In last year, the FI has withdrawn money from the Indian debt market. January, February, they've already withdrawn, but in March, they have already come back to the Indian market in debt market. Uh, Government inclusion in the global bond index, you will see that is the reason why in March the Indian debt market foreign FI flow has come up, because India has been included in the global bond index. RBI remained committed to anchor long-term rates. Well, as I mentioned, this already I mentioned in different forms, in the technical terms, where I will find that RBI will be supportive and you will not see a huge interest rate going up from here right now. Um, just spread valuations. I will not take much details. Rate outlook I have already mentioned, and key variables. Last couple of slides. Key variable inflations. Well, in short term, you will see a fluctuation in inflation, but not. But in long term, it will remain moderate. Rupee will also remain moderate. Credit growth will take demand will increase in medium terms period. Government borrowing in short term it has increased because of the COVID situation and all this thing, but long term, medium term it will go down. RBI policy, global risk event will remain neutral. Corporate bond spread is going to be down in medium term. If I debt flow, it's going to down in days to come. Currently, it is, we have seen a little bit of inflow out here, but debt you will not see a much flow because of the most of the money will go towards the equity segment. Liquidity, I don't think so. It will have a problem in India because RBI anyhow is taking a very close watch on the Indian banking systems and liquidity. Now, if you see the debt fund return in last 3 years return, now in debt fund also there are multiple categories. You will see the different debt fund. I have not mentioned the liquid fund return out here, which is the tune of 5% approximately. Apart from the liquid fund, you will see the return in different debt fund category. Year on year return is 9%, 8%, 7%, and 6%, and all these things return that you are coming. So even if you're looking for a fixed instrument investment, so you can look out for the debt funds which are giving you a much better return than normal fixed deposits. That's what today's presentation is all about. I wish all of you to be safe, stay at home, and stay invested. So if you have any query right now, so I just mentioned my link in my chat box. You just click on the chat box, drop your query out there. I will get back to you personally in that thing. I hope the information is adequate for you. So my on a nutshell, on 1 minute, I can say that for equity investments, do not come out of the equity right now. And if you're looking to invest in equity, I will recommend you that if you have a longer time durations, look out for a little bit of global exposure. Look out for equities which have asset allocation in place, because gold looks attractive right now with its price coming down. So equity, look for asset allocation product, a little bit of global fund if you have not exposure in equity right now. And whether if individual stocks, if you have make huge profit, let book the profit portion and stay as it is. Okay. And Bitcoin, I will say stay away from Bitcoin for a couple of months till the government announces bill in the parliament and passes it. Thank you all for attending today's sessions. Every month we conduct this kind of sessions so that you take an informed decisions of your investment. And okay, stay safe, stay healthy. Thank you. If you have any query, you can drop in the chat box or click on the link below in the chat box which I have mentioned. I will get back to you. Thanks.